We're gonna do a little bit of a dog and pony here, and thanks for the introduction. We would be officially the dumb plumbers. So thank you for that. Darryl and I both grew up in banking, and we're gonna show you a little bit of the other side of the coin on the transformation of financial services. Now, both of us have built a career in financial services. Darryl heavily on the risk scoring side. I've had a variety of positions, CIO, COO, CEO in 60 countries, focusing on transforming those specific businesses to survive in the future. So we pivoted on our presentation yesterday. We actually had a presentation on the future of banking and looking way in the future, which we actually called the Great Unbundling. It was alluded to there. We are very confident that there'll be one of two models for financial services companies in the future. One could be a fully unbundled broker or coordinator of products with data at the center to use those fintechs to be a superpower much beyond what they are today. And today, we would liken them to being like a department store, which in many instances died a slow and painful death, and that could be what's happening. On the flip side, they could switch to being deep product providers and competing with those fintechs. The jury's still out on that. But that presentation we are not going to do. That is going to be next year in 2022. If you'd like tickets, they're going fast. Talk to these women over here. So let's bring it back a little bit, and we're going to talk about transformation, and we're going to talk about sort of digital transformation, because the banks aren't going to go down without a fight. The insurance companies aren't going to go down without a fight. They are huge. So what are we doing? What were we doing to coach them to do this, and how is that going to work? Quick poll of the crowd. How many people have a bank account? How many people are giving it up tomorrow? Next year? 5 years? Okay, 10 years. Yeah, famous quote. We need banking, not banks. Who said it?
Bill Gates.
When?
1995.
1997, and this is something that Darryl and I will weave in the presentation we talked about a lot. But let's dive in. We're going to have a bit of a conversation. We'll see how we'll ping-pong back and forth, and we're going to talk about some of the major elements of transformation and what you can expect from the defense of the financial institutions, because often a good defense is better than a good offense. All right? So let's dig right in. Darryl, first slide.
So
we learned from Melania a lot about onboarding of people and meeting them where they are. So what does that mean for digital?
Briefly, I did risk management, now marketer, so I've gotten a lot softer from a behavioral perspective, but I spent my career basically doing behavior analysis on individuals. And those individuals, for the most part, were people either borrowing money or taking specific risks, preventing AML or ATF, identifying politically exposed people and other things. This is entirely kind of about the customer experience, the customer-facing part of the organization. We're going to focus here a lot on digital. Digital banking is now the center of banking. Right? The big shift we've seen in the last 5 years, and really accelerated in the last 2, is that now the digital bank is the primary area that you're going to do banking, even if you're dealing with Chase, Wells, pick a large bank, Santander, for example. The digital bank is the primary place where you're interacting. To get started, the first commandment we've put together here is digital lift and shift is not a strategy.
How many people have a digital bank app on their phone? Okay. Rule number 1 from when I was in business school, we're probably still teaching it today, location, location, location. They have an advantage. Banks have an advantage. They have you caught on your phone in that instance. That will be a little bit tricky to disrupt if they stay current and onboard well. Second part, so yesterday, Amos was very passionate in our breakout group. He was talking about a client that they were trying to move money around. I think they were jokingly say they were laundering money. The bank was not sure should they move the money around, and there was some significant friction that had them uncomfortable with forms and procedures. Darryl, is there such a thing as good friction? Because there's potentially some bad.
We'll get to friction in a moment. Just to finish up on the digital lift and shift, really what we're talking about here is that in a digital channel, and there's more than one, in digital channels, in this case we're focused in on the mobile phone, you've now got a different opportunity to engage in a different way. This representation here, the graphic representation here, is actually a graphical representation of my Lemonade insurance. And I'm applying for pet insurance. I've got a couple of dogs, and of course, you buy pet insurance because it's expensive in California to get your pets taken care of. And it's literally me having a conversation with the AI via chat. Now, this actually took longer than it would take to fill out a basic form because there's only 6 or 7 questions. But it was so engaging, so intuitive, that it wasn't about what that experience was around, I had to put a lot of data in. It was kind of a fun little felt like I was FaceTime chatting with somebody. The critical piece here is that you have to think through the channel. You have to make sure that you're taking advantage of how you can use that. Let's talk about friction. So, number 2 here is friction is not inherently good or evil. As I've mentioned several times, to defend the poor banking industry, I spent the bulk of my career doing risk management at the enterprise level in a lot of different countries, living in Japan, Vietnam, Canada, and the US. And there's all types of risks. And so the primary risk when we think of lending, if I think credit card or loans, for example, is there's credit risk, there's first-party fraud and third-party fraud. First-party fraud is probably the one that is least understood. It's that I qualify for the credit, but I'm honestly unwilling to pay, or I've lied to you about my income or some other basis. And how you prevent that is different than how you prevent third-party fraud, which is somebody doing identity theft or account takeover, and then credit risk, as I already talked about. So friction, when you put friction into a process, intelligent friction, meaning I am applying the right amount of friction for the perceived amount of risk, will help prevent both first-party and third-party fraud. It will make you appear serious. Now, if you get heavily handed on the evil side of friction, where I'm asking too many questions, the process isn't intuitive, good people won't go through that process. Bad people will. The problem with that, and the risk manager in me gets a little chill when I say that, is now you get what's called adverse selection, where some of the good balances aren't going to come in. All the bad balances will. So now what I've actually done is, through not taking more risk, through bad process, I've actually now increased my loss rate.
Great, so quite interesting. As we start to look at the contrast between fintech and new tech and the bank history, often seen as negative, there's things that are built in here inherently and that learning that need to come to those fintechs to be successful and win regulators over in the process. So a third piece we wanted to talk a little bit about is the personalization of banking. Okay, everything is going heavily digital. Fintechs are heavily digital. Part of the way they compete is because they have 10 people versus 10,000. The history of banking grew out of personal relationships. We saw in one of the presentations yesterday I think it was a French bank note, where often in history there were personal bankers in every city. So if you go to Canada, rural Canada had personal bankers in every city. They were part of the fabric of the city. That became the banks, which became the super banks. This still exists with credit unions and a lot of banking institutions around the world. The US is still quite fragmented. A lot of that is built on the personal relationship of who is actually doing the finance with you. Now, the question is that a tenable and sustainable model? It's something that the banks do bring to the table. You could question, do I want to pay for that? We heard from Ian. He went into the branch with his parents, and that was the experience, because that's the experience they grew up with. This is changing rapidly. Darryl, what do you think is going to happen in the personalization space, and can banks take that previously competitive advantage and bring it to the forefront now?
Yeah, I think what we're seeing, and we see this in a number of ways manifest itself. The simplest way is contextualization. Right, I'm on my app. Banks have all kinds of data on us, and if they're smart, they've got even more than we perceive they have. Device data, they've got behavioral data, they've got all the transaction data you've had in the past, they got how fast your keystrokes are, they got how fast your keystrokes might be on your PC, tons of information. This contextualization shown here, again, is one of my favorites, Lemonade, and it's thinking about the customer experience from a branch perspective. You walk into a branch, somebody greets you, says hello, they smile with you, how can I help you today? Well, that's gone, right? Because now we've got this device, and it's impersonal. Well, wait a minute. Good morning, Ron. Exclamation mark. They're excited. It seems corny, but it actually has an impact on you when you're reading it. Great to see you. Good morning. I've gone into this app in the morning, in the afternoon, and evening, and they do say good morning, good afternoon, good evening. So they understand where I am in the world, because I went in there this morning to verify that it would work when I was in Madrid, and it said good morning, even though it was evening in California. That's a real simple approach to personalization and contextualization. There's very complex ones where I might have savings goals, and they might be working with me to encourage me to save more. It could be that I had 2 transactions that were the same, and they reached out to me to verify, hey, Darryl, did you have 2 transactions for $40 at your local pub? And I said, of course I did, right?
So interestingly enough, Darryl made 2 references to lemonade. Lemonade, how many know lemonade? Okay.
They've done their job well, haven't they?
Yeah, very good. Yeah, exactly. So what's interesting about Lemonade is it is a fintech, in fact. And I don't know if you saw, they bought Metromile 2 weeks ago, 3 weeks ago. Metromile being a telematics driving pay per drive. They have 100 million trips in their data pool. So you talk about personalization and what's possible. The data that is coming to the fore is actually going to be quite impressive. Now, that is a fintech. We could talk about fintech versus banking. Again, our view would be that the banks will start to acquire the fintechs because most, if not many, of the fintechs are not going to get the scale. So suddenly you take a lemonade-type approach, take that data, plug it into a bank using some of these elements, then I think you've got a pretty strong contender. But we can get into that debate around fintechs versus the banks in a few minutes. So let's pivot a little bit. We heard about data, and you made, I think, a joke about data. I've had a lot of experience of data. I've run data teams. My last job and previous jobs I've had the data team. And ironically, I used to joke with one of my recent teams, I can't say who, because this is on video, but I said, well, how about we actually just start with little data? Because the banks and insurers have been talking about big data for millennia, it seems, and the progress is absolutely painfully slow. And unfortunately, that's one of the biggest crimes in my view, because they are in a pole position to use that data. All of you just said you have bank accounts. Your core accounts have decades, years, if not decades of data about you, your spending habits, etc. This is a competitive advantage the banks have. I would argue have not used it, but could come out quite aggressively if they invest appropriately, whereas fintechs may struggle with this. And we can talk about open banking. I think it's a fascinating topic. I think it's going to move much slower than we actually think. In Canada, it's an oligopoly. The banks are, I mean, they wouldn't say this officially, they are pushing back on open banking. It's going to take a long time. So data, Darryl, you spend your entire career really in data. Can the banks step up fast enough to compete on the data front with open banking and other things coming?
Yeah, I think if you roll back to a decade ago, the biggest thing the banks had as an advantage is they actually had all that data. Now, they've been squandering it for quite a while. Arguably, they had trust. Trust has been eroded for the most part. But if we roll back to today, SoFi in the US has bought a bank. They've been around for a decade. They're well known, and the banks kind of ignored them because they were this little lending company that bought off student loans that the banks didn't want to buy. Well, today they have an investment arm. They have a full services credit card. They have all the basic core banking accounts. And guess what? They have data, and they have a brand that's recognized and trusted more than banks like Chase, Wells, and Citi. I've got nothing against either of those 3 banks. I have accounts at all of them. I have 130 financial services apps on my phone if anyone wants to have a look. Respect the data here, though, is really talking about, again, I talk about these little things and then the big things, right? Respect the data, meaning when customers give you information, when they generate data by using the app, give them value from that. One of the things that we saw in a study that I did in the last couple of years at the firm I work for is that customers will provide you with information if you can generate value, demonstrable value for them. Right? It's not about being super private. It's about giving value for that information, having them understand why you need it and what you're going to do with it. The example here is a silly one. It's actually showing how many points. I think it's how many points I've gotten since Monday on my Amazon Prime card, 3,549, which does mean I'm spending way too much on Amazon.
Perfect. So yesterday we heard from Ian, who is a different kind of consumer. He talked about how he could normally spend 3, 4, 5, 6 hours a day on his phone. On TikTok, he uses an example. He's not on it now, but that's because I think he knows I sit beside him and I'm going to give him trouble if he's on his phone. But the reality is, how do you engage an Ian? How do you engage, like, we've grown up in banking, but how do you take this new generation and actually say, we're going to get you to this old stodgy bank when you can go to a Lemonade or you can go to some of these other things. And as you know, these guys fly around apps like nobody's business, right? So one of the questions is, can we grab and engage those users? Darryl, can we do that?
Yeah, so now that I'm in marketing, I know exactly how to do this, right? Because fundamentally what you got to understand is that you've got to go to where your clients are now. And that doesn't mean you go to their mobile phone. It's actually much deeper than that. You've got to go to where they literally are on the phone. So Ian had mentioned that he's, spends 10 to 12 hours a day on TikTok. I similarly do as well because, I never matured past 17. So, but the point is here is twofold. One, you got to go to where your customer is, whether it's Snapchat, whether it's Facebook, whether it's TikTok, to provide them information and to engage with them. That's both brand building, that's both marketing, as well as just making sure that you understand how they like to be communicated to. The other one I will say here is that millennials have taken it on the chin for the better part of 15 years of having no attention span. Nothing could be further from the truth. It's not that you have 7 seconds to keep their attention, it's you have 7 seconds to impress them, right? That's fundamentally different than they're just going to drift off somewhere. You're constantly needing to impress them in the channels that they're in.
Very good. How many people have been to a bank branch in the last year? Wow. One of the things Darryl and I talked about even when we worked together in 1996, everybody said the branches are dead. We grew up in a branch. We started as tellers, literally worked our way up to, when I was with Darryl in mid-90s, we had a $4 billion credit portfolio. But everybody said the branches are dead. And then they're not dying, and then they're dying, and they're not dying, and they're dying. And this argument goes on for some time. You guys just showed you've been to a branch. So the question really becomes, that's a major element on the balance sheet and the cost structure of a bank to compete with a fintech. The fintechs, it's an advantage. They don't have branches. Or is it really an advantage? Or are they positioned differently? So Darryl, what do you think about that? Are the branches going to close? Are they going to disappear?
If you're a full-services financial institution today, you have bricks and mortar, right? We know in the last 5 years in most of the first world countries or most of the well-developed data countries with high digital banking usage, that the amount of branches has really been constricted. There's still a use for these branches. I think many institutions are thinking about how to utilize them. There's an urban-rural difference. Rural communities go to branches more often than urban settings, even though there are more branches in urban settings, which doesn't make sense. But fundamentally, you have to continue to understand the value that they may bring. Whether or not in today's age you actually have virtual assistants that actually work in branches that can both serve people virtually through Zoom, WebEx, or whatever product, as well as have people that they can serve there. Or maybe it's their complex products that are being sold. For many people, a mortgage is an incredibly uncomfortable experience. It's a big purchase, and maybe they want to be led through that. So maybe branches can be utilized for those. We've also got a number of generations. We've got arguably 5 generations, although one would say 4 generations that are doing banking actively, and everybody might want to do that in a different way. But you got to right-size your branches. Branches also have this inherent ability, as you drive by them, to provide you with trust or brand. If they can have a building, they must be good enough to exist. That's diminishing, but it's still somewhat true.
Very good. So we mentioned at the intro, one of the things we've both done is a lot around efficiency and driving change in financial institutions. And speaking personally, one of my big things you'll see when I speak, I took 200 million euros off the balance sheet of ING Insurance for our IPO. Now, in doing that, a lot of that was the absolutely unsexy stuff. There's tens of thousands of people in these institutions, and getting the kinks out and working through how to make them more operationally efficient. Because what's happened is products got layered on, products got layered on, products got layered on, and the efficiency really dropped and dropped and dropped. So I have spent in my career inordinate amounts of time reducing those costs. And there's very good reasons to do that. I won't bore you with that. We could talk at great lengths. I can show you the scars from change management. It's very, very difficult. But one of the elements is do you want to totally depersonalize the process? So how do you feel about that, Darryl? Because there's processes, and then there's, we saw in blockchain, it can be absolutely lightning fast. But is there any advantage to having some manual steps in that process, and can the bank survive with these expensive processes?
Yeah, I mean, there's an answer that covers off probably half of these commandments, as well as some stuff that's already mentioned here. I think fundamentally what we're seeing and desiring as financial services providers is automation. Automation in its most intelligent sense, right? And automation where people want it automated, right? There are aspects to things where we want to provide friction, and some of that friction might be as harsh as forcing them to on the phone or to a branch, although I would argue that why force them into a more expensive channel when you can make a more intelligent decision with data? This commandment is really about where people spend time with you, provide you with things, match that effort. Right? If they're in your app on a regular basis and they're looking at specific things, make sure the order of the things on the home screen actually match the things that they care about. And then through automation and decision systems, deal with the costs that actually will create efficiencies to create better products, better priced products, and a higher degree of automation. One comment I would make here on fraud management, one of the things that people have this perception of is that there's way more fraud in the digital channel. Okay, there's way more tools in the digital channel to prevent it, right? I helped set up an online loan insurance company, a loan provider in Canada in 2014, and through 2014 to 2017, we did not have a single instance of third-party fraud. We looked at 25 different data sources, and most of those were automated, but it can be done and done quite intelligently.
Okay, just conscious of time. We're getting close to the end. We're almost there. What about the engagement side, and you know, how do you get IN and these folks engaged with regular frequency without being a pain?
Well, I mean, the age-old challenge of communication is how much do you want? And so through data analysis and other components, you can actually do this in today's context. But the way to start, and there are these communication platforms that most institutions have invested in, or most intelligent institutions have invested in, where you can actually set up a rule-based structure to allow your clients to say, hey, here's the kind of transparency I want. I want to know every transaction over $100 that is card not present. Now, card not present meaning it's an internet transaction or some other type of transaction where I'm not there. You can set it up that if there's a duplicate transaction that I can do that. You can set it up so that any deposit over an amount, so basically any type of transaction that you would want to make, you can get a notification for that. And you can set up your risk level and peace level. And it's actually incredibly easy to explain how to do that. I get every single transaction that goes through my account, I get an SMS that says something's happened. Why? Because I'm paranoid. But that's the pester me. That's what I want. IN might want, okay, only things over $500, right?
So yesterday we talked about brand. I think it was Fernando, I think, that gave us no, it's not. It's Mark that presented on brand yesterday. Apologies. Mark did a great presentation on brand. And Mark, I think you mentioned, and I know I feel that many of the banks are rather disingenuous when they talk about being your partner for life and helping you and financial wellness. I actually have an allergic reaction to that. Darryl, as we think about brand, how do we deal with this? Can they actually have a purpose that's actually meaningful?
Yeah, I mean, I think we've talked about it a lot over the last day and a half. Financial wellness is a massive theme in the financial services industry, and many truly mean it. I think when we were talking last week, we actually looked up the vision and purpose for a handful of financial institutions, and everyone's talking about it. I think that how this manifests itself for me is that put the customer's outcome at the center of every discussion you're having, right? Be fascinated about what they're doing and what they're trying to achieve. The technology's got to be an enabler. It's got to be there, and it's got to enable, it's got to improve, it's got to become more efficient. There is a purpose for all that, but fundamentally, you need to be focused on customer outcomes. And not everybody's outcome's the same, right? I'm getting closer to retirement, and I'm still investing in DeFi, not so much in crypto. But be fascinated in what I want. Utilize the reams of data that you have on me. Chase has 4 years worth of transaction data. I transact 3 or 4 times a day. They use that information. In this case, it's actually on the screen here. I think it was a trivia question about how much are you spending on groceries a month? How much does the average person spend on groceries? They didn't say that I had spent a lot. I answer the question, well, I get it wrong the first time and there's no celebration because I'm spending $1,000 and this is setting the average household spending $500 and change. And then I had to go back in so I could get the confetti. This was a very indirect way to teach me that I was overspending. An interesting way to get a financial wellness. Darryl, you're spending way too much at Whole Foods. It's my wife and she's buying a lot of organic. And I sometimes buy a little wine there.
All right, we're almost there. So let me ask you one other question. Why do you guys have bank accounts? How many people would trust putting, you did this in an investment question, how many people would trust putting all their money with a fintech? Sort of a couple. How many of you would trust putting all your money in your bank? Yeah.
Well, we get a few more.
A few more, or I've lost a few people. There's a big trust element here, and we talked about blockchain and crypto and the trust in the block and how you can have that versus the trust in banking. And we've seen some bruises. You talked about, there was an Equifax breach where Equifax, which is a large credit bureau, lost all sorts of data. There's all sorts of challenges in the trust factor. So the big question is, where is that trust going to lie? Because that is going to be a very important one as we go forward in the future of financial services. So almost bringing it home, Darryl, make me feel safe.
So 2 quick comments here. The first thing you have to do is literally be safe. You fundamentally have to lock down your platform. Tied up in your brand, tied up in creating trust, is in fact not screwing it up. Secondly, and possibly more as important, is when you're in the app and when you're asking for things, you have to create the perception of trust. You have to create transparency into why you're asking for them to do things. If I'm asking for the front and back of a driver's license and a facial, let them know why you're doing that. You're stepping up the risk to enhance their security. Create icons that make them feel like there's a lock or a fingerprint. That's the perception of preventing risk, creating trust. Both are required.
So we're pretty much wrapped up. We're going to get one more point in a second, but what did we want to do here? We basically were showing you that, we've built our careers being the dumb plumbers. And what do I mean by that? We've been working with financial institutions to transform them, and they're not dead yet. They're not down yet. There's a whole bunch of factors that go into building that symphony of players, if you will. Everything from trust, from brand, from product, from innovation, all those elements coming together. The banks aren't going to disappear tomorrow. Are they the end solution? No. And in full disclosure, I've left banking and I'm doing a startup, which some of you know, we got the first round of pre-seed when I was in the plane on the way here. It's around disrupting a profit pool in banks on financial wellness because I think they're disingenuous as hell, and I think there's a huge profit pool and a better societal value we can drive there. So that's not the point here. But the point was to be made that the banks are a force to be reckoned with, and there's a lot of people focused on transforming them to meet the fintechs at that front line. Darryl, how do you put it all together?
Yeah, so a couple things. One is, this has been heavily digitally bank focused. The reality is this could be a disaggregated super app that delivered products from various institutions in one place. Everything we said here would be true for that, as well as a digital-only full-services financial institution. You have to do all of these things well, right? There are a handful, at best, banks in North America, for example, that are doing this. And none of them are, one of them is a top 25 bank. I love this little quote here. Only those who have the patience to do the simple things perfectly will acquire the skills to do the complex things easily. And maybe with that, we'll wrap it up because we are well over time.
Gentlemen. Did I have a...